As far as the South African economy is concerned, our economy has continued to grow, and so in that sense we're fairly good, but at a slower rate, as I pointed out earlier, projected at the time of the 2012 budget as a GDP growth of 2.5% in 2012, and is expected to grow at 2.7% in 2013 and 3.8% in 2015. But these are just forecasts. They can be right, there can be more optimism around them, there could be more pessimism, depending on how the rest of the year develops. Inflation has remained moderate, with consumer prices rising by 5.7% in 2012 and projected to increase by an average of 5.5% a year over the period ahead. Our trade performance needs to be better. Exports grew by just 1.1% in real terms last year, while imports increased by 7.2%. The deficit on the current account of the balance of payments was 6.1% of GDP. This means, in simple terms, that expenditure in the South African economy exceeded the value of production and income in the South African economy by 190 billion rands last year. So that's the gap we have in our economy. That's the gap we need to fill in by people investing in this country, either in shares, in bonds, or in the real economy itself. This is partly a consequence of the disruption of mining sector activity and the structural reduction in mineral exports due to lower demand elsewhere in the world. Some of the foundations of faster growth are indeed in place: strong capital investment by the public sector, the addition of electricity generating capacity, relatively stable inflation, and the low interest rates will support improved growth rates over the medium term. But this is not enough. Much more is needed. In particular, a significant increase in private sector investment and competitiveness is needed in the wider economy, in agriculture, in manufacturing, in tourism, in communications. Every sector has to play its part in expanding trade, investment, and job creation.